Okay, the last chapter we're covering is about personal finance. Can I have you guys stop talking, please? Yeah. Personal finance, hopefully this will be useful for you in your life to kind of start thinking about how are you going to manage your finances, your money, your future, right? This is a very short chapter, but we're going to go over it, but also rather quickly. Creating a financial plan, we all talked about your career plans and you had to write the paper about that and all that. And a very little section, there was one question about what are your financial goals, right? To create a plan, first, you're going to have to set goals. What are your goals? And then you come up with a plan, how you're going to get there. Money management is a key aspect of personal finance and includes determining of how much money you have, setting goals, what you want or need. So you can do that by setting goals such as I want to buy a new car in 2 years from now, or I want to buy a house in 5 years from now, whatever it might be, right? That's how you're going to determine how much money you will need, right? And then you're going to come up with a plan how to achieve your goals. So that part of that was your career plan, right? Getting an education so you can get a higher paying job, right? It was one of the things that was kind of part of in your paper, how to achieve your goals, including your financial goals. So you would have to take a financial inventory, right? Remember we talked about a balance sheet, right? It gives you a snapshot of what you have and what you owe and what is your, in this case, we're going to calculate our net worth, right? So, some of the things you might have as this, I'm not going to go over all of them, but your assets, things that you have, right, that are of value, could be your cash in your checking account. Maybe you have $500 in there, right? Maybe you have $1,000 in your savings account. That's $1,500 in cash as an asset that you have. Some investments and so forth. Maybe you have a car that you bought and you've driven it several years and maybe now it's worth $7,000. That's an asset too, right? Later on you might have real estate, a home that you live in, right? So you add all of that up, and let's say your net worth based on all these things is $20,000. Right now you have a car, you have cash in the bank, you have maybe you put in money into an IRA, individual retirement account, already. We're just saying you have 20,000 net worth, right? Now you're going to look at your liabilities. What do you owe? Maybe you have a credit card where you owe $300. You have a $300 balance on a credit card. By the way, pay that off ASAP. Don't pay any interest, right? What else let's say your car isn't completely paid off yet. It's worth $7,000, but you still owe $4,000 on your car, right? So you still have a loan. So that's $4,000 in liabilities. Let's say that's it. You have no other loans or anything like that. So you have $20,000 in assets and you have, we said $4,300 in liabilities. So 20,000 minus 4,300 is 15,700, right? That would be your net worth. That is, if you sell everything you have and pay off your debt, you end up with $15,700. Questions about that? And as you get older and have more assets, like, hopefully all of you will be homeowners one day, even though it seems impossible, nothing is impossible, right? A lot of you have, all of you can one day be homeowners, right? So you're going to have a home. Maybe the home is worth $1 million. So you you have $200,000, you put it as a down payment. Sounds like a lot of money right now. Don't worry about it. You're all going to do fine. So now you've put down $200,000 on the home. It's worth $1 million, right? The day you bought it, your net worth, if you take out everything else, or on that home is $200,000, because if you sold it for $1 million, you have to give $800,000 to the bank, right? And you end up with $200,000. Let's say 5 years from now, you have paid down, and you pay it down usually in over 30 years, right? But most commonly, right? So you paid down, maybe you paid down, I don't know, I'm just throwing out, you paid down $100,000 the first 5 years, right? Now you have $300,000 equity. Let's say market is really great. You know what happens in the Bay Area to home prices? They go up. Let's say now your house is worth $1.2 million. So now, if you sell your house for $1.2 million, you now only owe $700,000 to the bank because you paid off $100,000, right? So your net worth now is 1.2 million. You sell the house for and pay $700,000 to the bank. It's 500,000, right? So I don't know if I'm confusing you or if you're following, but that's how you calculate how much your net worth is, by paying off all your liabilities and keeping by selling your assets and paying off all your liabilities. How much cash would you end up with? Most likely, you're never going to do that in your life. But it's important if you, let's say you want to start a business or something, asking for a loan, banks might ask you for your net worth and things like that. So questions? Okay. So setting your financial goals, you have short-term, long-term goals. Short-term should be simple, measurable, and realistic. Maybe you have a credit card that you still owe $300 on, and you can't pay it off all at once, but you say, I'm going to pay extra and I want to have it paid off in 6 months, right? And based on that, you're going to make those payments. Long-term goals should also be realistic, but motivational as well. And we all kind of, you all wrote about your long-term financial goals in your papers, right? And you know what it takes to get to that. You can break down long-term goals into more manageable goals, just like what we did in the paper. What are the steps you have to take to get where you want to be, right? You want to be a homeowner by the time you're 35 years old, and you want to be married with 2 kids. Very common goal, right? And then you're going to break it down. Well, first I have to get married. You know, I'm going to find somebody rich to get married to. So it'll be, no, I'm just kidding, of course. But anyway, so one step at a time, right? You're going to kind of say, makes sense to do this first. And then step 2 would be this, step 3, that, and so forth. Prioritize them. Put needs above wants and short term above long term. So, you know, what do you need and what do you want are 2 different things, right? We always think we need one more of something, but we don't need it. I mean, we really just want it. So that's one way you can manage how much money you spend also. And write the goals down and refer back to them. Writing them down is always a good idea. And then you need to look at where your money goes. You know, you have, well, this doesn't have the income, but this is, if it had the income, it would kind of almost be like your income statement. This is, or cash flow statements, I should say. This is the money that's coming in. Maybe you have a part-time job. Maybe you're getting about $1,000 a month, right? And where is that money going to? So make a list and of your expenses, monthly expenses. All you need to do is look at your bank account, bank statement, and see where it's going to. Right? How much am I spending on a phone bill, on my phone monthly? What about all these streaming services? Maybe look at all the streaming services and think about, wait, I really haven't watched this in a long time. I think I can cancel it. That's going to save me $15 a month. Don't waste money. Maybe you've gone out a little too much. Entertainment, you know, going out, eating out, going to Starbucks, paying $4 to $5 for a cup of coffee that you can, you know, make at home for pennies. Maybe even better. So I, you know, a long time ago, I've invested in one of these super automatic espresso makers with foam and does the cappuccinos with you just push a button, right? Except, you know, the milk foam you had to do separately. But I justified it and said, I'm going to drink less coffee out. And I really did. And it was really I really got the return on my investment, right? And it was a very expensive machine. It broke after 6 years or something like that. Now I have one of those manual espresso makers, works just as fine. Anyway, you've got some regular expenses and things like that, right? There can be unexpected expenses, car repairs, or something happened to your car. My car is 10 years old. Every few months, there's another new red light coming on about checking this or that, right? And I'm trying to keep it as long as possible. I never had a car for that long. But at one point, if the repairs become too expensive, it doesn't make sense for me to keep that car anymore, right? Speeding tickets, yeah, you're in control of that. Just don't speed, right? Just don't speed, and don't park in the wrong spots. Yeah. Any unexpected medical bills, any other unexpected expenses, those we don't have control over, except speeding tickets. You can control that, right? But it's still unexpected usually. And don't drive in the carpool lane as a single person, ever. That's so expensive. Then you create a budget. We're not going to go over this, but you're basically going to look at what do you have coming in every month, how much can you spend, and how much do you want to save? It's never too early to start saving for retirement. I made that mistake. I was thinking, that's so long away. Me getting old, I couldn't even imagine that, right? Now I wish I had started saving. Now I wish my teachers told me start saving for retirement now. IRA, individual retirement accounts, right? Tax-free savings. You don't, basically, if you make $10,000 a year and you put $3,000 away for an IRA, you are only taxed on $7,000 for that year. You are taxed when you retire, when you take that money out. And most people, when they retire, they make less money, so they're on a lower tax rate. So if you work, even if it's, just a part-time job, if they have some 401k or other opportunities to save, where maybe the retirement or IRS is taken out automatically from your paycheck, where you're not even missing that money, you're not taking it first and then putting it away. Just if you can do those automatic deductions, go ahead and do that, right? So you want to be a millionaire? What is the key? Compound interest. We talked about compounding interest rate. If you put money away, if you put money into some kind of account that gives you interest, such as high yield savings accounts or CDs or bonds and all these things that we discussed last week, the interest that you receive at the end of the period gets added to your principal of the amount that you receive interest for the next period. So here you invested, it's an example of an investment of $1,000 at 6% at the end of per year, right? At the end of the year, you have $1,060. Now $1,060 gets invested. So you make not just another $60, but you make another $63 in this case, right? And so on. And if you get constant 6% interest for $1,000 that you put away, after 25 years, you have $4,291. And $1,000 a year, of course, that's not enough to put away to retire well, right? And you will make more money that you can put away more. There are, if you can, always, once you start your career, always do the maximum limit you can that you are allowed to by law. That Uncle Sam will allow you to put away tax-free savings for retirement, right? All right, then you have to execute your plan again, track your expenses, pay off unpaid credit card debt. Number one thing, really, if you have credit card debt, focus on paying that off first, because it's very, very high interest, over 20%, pretty much almost all of them, right? Some of them as high as 28, 29%. So if you have loans, well, that's later on, you might have some larger loans. You can reduce interest rates. If you have, people that buy a house right now, they will buy a house at very high interest rates. They're so high right now. Eventually, interest rates will go down. You can refinance your loan. and get a lower interest rate loan, right? So, always be on the lookout for things like that, low interest rate loans, what's happening in the market. That's why I also tell you, keep up with the news and keep up with business news. Once you start investing money, keep up with investment news. Look at your investment and see how it's doing. Try using cash only. When it says cash only, I'm not talking about you need to have cash in your wallet, but what you can do, and this is what I do, is I do use a credit card. For almost for anything I can use my credit card for, I will use my credit card because I get points that I can then use for traveling, right? But I pay the whole bill off every month, so I never pay any interest, right? So for that, I need to keep track and not go overboard where I can't pay off my bill anymore. Monitor and access your plan, make adjustments as needed, right? Managing personal credit. Everybody wants really good credit. Why are we all so obsessed in this country about having a high credit score? Should we even care? Yes, you're shaking. Yeah, you're saying yes. Why is it important?
You can buy like a house for less interest, car, stuff like that.
Yes, you can buy a house or a car or get a loan for lower interest rates if you have good credit. If you have no credit, you can't buy a house, period. It's rather unique in the United States, the way mortgages work, by the way, that you have a fixed mortgage for 30 years is very unusual. In countries like the UK, I think the rate gets adjusted every 2 years or something like that. So if the interest rates go up, like they have gone up, that could be thousands of dollars in mortgage payment a month at the home prices we have, right? How do you establish credit? You got to get a loan, so you have to borrow money to establish credit. So the credit bureaus can track if you pay your loan regularly, right? You don't have to keep a balance on your credit card to do that. People used to say, oh, don't pay off the whole thing because it doesn't give you credit. No, that's not true. You do get credit for paying it off, even if you pay off the whole thing. Some of the other things you can do is if your parents are nice enough and they have a credit card and you have a card, they can make you an authorized user. So that credit card, as long as your parents pay them off regularly, you collect credit because now you are also a responsible party for that account. But you didn't need to prove income or credit because your parent already did that for the amount, right? I did that for my daughter, and now she has her own credit card, so I took her off of it. But that helped, get car loans. If you can get your parent to co-sign your car loan to get a lower interest rate, I did that for my daughter as well, right? Otherwise, her interest rate would have been really high. She bought her car 2 years ago when she had no credit, right? So, so you establish a credit history. And the more, it's kind of horrible, but the more debt you have and the more you pay off your debt, the better credit you have. But so when you have debt, use it smartly. Use it for things that are necessary, like a car or a home, right? Know your credit score. What is a good credit score these days? Does anybody know what a good credit, the number of an excellent credit score? 800 and up, yes, is excellent. I don't know how common that is, yeah. But if you have 700 and up, you can already get good interest rates, right? 600 and below is probably not a good score. Car consideration, should you buy a new car or used car or new used car? What's a new used car? It's kind of like a used car that's not that old and that you buy from a dealer and it has some kind of certified warranty for another couple of years, something like that, right? But new cars are very expensive. Very, very expensive. Used cars used to be cheaper. They have gotten quite expensive too. If you're driving a car that's old like me, mine is 10 years old, I'm holding on to it. you know, I don't wanna spend a lot of money on a new car. And I don't wanna spend money on a used car either. I have a used car. Why sell it and buy another used car, right? Yeah. When my car dies, when I can no longer use it, I will buy an electric car. I already, but I don't know what kind yet. Hopefully by then we'll have even more options, right? But one of the considerations is fuel and maintenance. Electric cars have such low maintenance. You don't need oil changes. All you need is brakes and tires, really. I don't know what else you would need, but it's quite expensive to keep a car. Well, the new cars, the good thing about new cars is maintenance. The first 3 years practically is a lot of dealers include the maintenance already when they sell, the manufacturers of the car include first 36,000 miles, all the maintenance is included, right? Insurance is more expensive and things like that. Used cars, you might have more problems. When you buy a used car, you really never know what you're getting unless you're a mechanic. So new used cars is an option because you're paying much less, but you're still getting the warranty from the dealership. You know what leasing is? Leasing a car versus buying. So a lease essentially is like renting a car, just long term, right? And there are some advantages of leasing a car versus buying a car. I'm not going to read off of this. I'm just going to mention some of the big differences. Is at the end of a lease is for a fixed term, commonly 2 or 3 years, right? So you basically enter into a contract to keep the car or to lease the car for 3 years, and your payments are set. For 3 years, the payments are every month you're going to make X amount of payment. At the end of 3 years, you own nothing. You return the car. If you buy a car and you finance it over, let's say, 3 years, just to make it similar, and you make payments over 3 years, at the end of 3 years, you paid off the car, you get to keep the car. But the difference is car payments, if you buy it, are much higher than the lease payment. You can lease a car easily for $200-300, but if you bought that car a month, right? If you bought that car and if you didn't put money down, easily your payment could be $600 a month. The way leases are calculated, so at the end of, let's say you lease a car that costs $30,000 and your payments are $300 a month. And you do it for 3 years. At the end of 3 years, the contract will give you a residual value. In other words, they estimate what this car is going to be worth at the end of the 3 years. And usually the payments you made are about equal what it would be, you would have paid down that amount. So maybe they say at the end of 3 years, this car is worth $20,000. Well, you kind of paid $10,000 for the lease, but then you own nothing, right? There's a disadvantage of leasing, besides not owning the car at the end, is you get limited mileage. It's not unlimited. So very commonly, if you see these really, really cheap lease deals, they're usually, you only get to drive $10,000, 10,000 miles a year. If you have a long commute to work like I do, that would not be enough. And then you pay something like 25 or 35 cents per mile that you drive extra, and that can add up. So that is another disadvantage. Or if you want to go take a road trip, if you have a leased car, it's probably not a good idea. Insurance is a necessary evil. We have to have insurance. By law, certain things have to be insured. We have to have health insurance. Thank God we have Obamacare, the Affordable Health Care Act, right? A lot of people would be without insurance today if we didn't have that. And the California one works particularly well, right? Disability insurance, usually you have that through your employer when you work. Car insurance, obviously. Do you know the difference between these? Liability, collision, and comprehensive? Liability is the most expensive part of your car insurance. It's anything you cause, any damages you cause another party, the insurance will cover. So if you hit somebody while driving and that person has damages of $300,000, the insurance will pay for that. There are limits, by the way. Collision is, what happens to the car repairs when you get into an accident and your car repair costs $10,000, the insurance will cover that. Comprehensive is you have your car parked and somebody, I think it's when, an example would be when somebody hits you in a parking lot and you're not even in the car, right? It wasn't an accident, like where two cars collided. It wasn't a collision. Anyway, these have different deductibles usually. This is usually higher, this is lower, right? Because the damage on these is also much lower. It's usually, the car is not gonna be totaled if somebody hits you in the parking lot. But here the car could be totaled. Homeowners or renters insurance, homeowners insurance, absolutely, you have to have it. Renters insurance, a lot of times landlords will require you to purchase renters insurance, right? And some people purchase life insurance. Why do they do that? What's the purpose of life insurance? If they have children, right? They want to make sure they're taken care of in case something happens. Questions about insurance? All right. Investments, we're not going to talk in detail about that, but Roth IRAs are really, really good ones. Those are the ones you can invest in after you pay taxes on your income, because then when you take them out, you're not taxed on it again. So for your retirement savings, you can pay interest you can pay taxes either when you take it out, when you retire, or you can pay the tax now, and when you retire, you don't have to pay the tax anymore. If you work at large companies or organizations or state or government agencies, teaching, things like that, you get pensions, right? There are different type of pension plans. I'm not going to go through them, but and then there are 401k, 403b, and 457. These are usually if you work for a government or state or education. This is for private industry. 401ks. What's really great about 401ks? A lot of companies match 401k contributions. So 401k is a retirement plan. You can put money in from your income pre-tax, right? So and some companies will match up to a certain percentage that you can save. So they will say, we will match up to 3%. If you put away 3% of your income in your 401k, we'll give you another 3%. 3 to 5% is very common. If your company matches, max that out. It's free money for retirement that the company is offering you. Why would you not do that? Taxes is another necessary evil, right? You have income, your salary, if you have investments. Okay, so for your, when you have investments in your retirement accounts, you don't pay taxes on the gains that you have while the retirement account grows, like the 401k, for example. Maybe the total amount you put in there is $100,000, but by the time you retire, it's worth $180,000 or something, right? You're not going to pay every year taxes on the growth of the investment. You just pay taxes on it, not even on the growth of the investment, but usually you take it out as a monthly income, right? And then you would pay taxes based on your tax rate back then. So the only time you pay taxes on your investments, if you, let's say on your own, you have stocks that you make money on, and you buy the stocks for $10,000 and you sell them for $17,000 in a given year. Now you have to add $7,000 of taxable income. Anyway, just a summary: set your financial goals, make a plan to achieve them, and stick to it if you can. But things change in life. Maybe you had one career in mind, but you completely changed, or you moved somewhere else because you fell in love or something like that, right? Things happen. Yes. Pay yourself first, start early and pay often. I'm not sure what they mean with that bullet, honestly. Anyway, use debt wisely and establish good credit and make sure you and your assets are insured. Right, so don't be reckless. Any questions? Let me stop sharing.